Let's get right into it. Today, we're throwing out the old playbook for international real estate investing. Why? Because in a world that's increasingly fractured by geopolitics, the single most powerful force shaping property markets isn't just capital anymore. It's the movement of people. So let's break down exactly what that means for your portfolio. Right now, the name of the game for investors is de-risking. You know, that gold rush for high risk, high reward, growth in emerging markets, that's pretty much over. As geopolitical fault lines get wider, capital is making a very deliberate retreat to the safety and predictability of mature, stable democracies. This isn't just some passing trend, it's a fundamental shift in how global money is finding a home.
And this isn't just a gut feeling. We're talking about a seismic shift in how investors see the world. I mean, look at the speed of this change. In just a single year, the number of real estate leaders in Europe who see deglobalization as a major threat more than doubled. It went from about 31% to over 70%. This tells you the problem isn't on the horizon, it's here, right now.
Okay, so here's our game plan for today. We'll start with that big picture, the new geopolitical paradigm. Then we're going to zoom in on 4 really different case studies: America's policy paradox, Canada's demand shock, the refugee impact in Europe, and Asia's wealth migration. And then we'll wrap it all up by putting these lessons into a new actionable playbook for you. So first up, let's tackle the United States. This is a really fascinating case because we're seeing a policy that has completely opposite effects. A major U-turn on immigration is squeezing both the supply and demand sides of the housing market at the exact same time. And that's creating a pretty volatile situation for anyone invested there. And this slide really lays out that paradox perfectly. It's like pressing the brake and the accelerator at the same time. On the one hand, from the demand side, the policy tries to cool off a blazing hot rental market by cutting the number of new arrivals. In theory, fewer new households should mean less pressure on rents, right? But, and this is a huge but, on the supply side, that very same policy chokes off the supply of immigrant labor, which is literally the lifeblood of the construction industry. So it gets harder and way more expensive to build the exact housing the market desperately needs. And the scale of this policy shift is just staggering. After years of major inflows, the U.S. is projected to see net migration go negative for the first time in half a century. And just to be clear, we're not talking about a minor tweak here. This is a full-on demographic U-turn, and the economic fallout from this is going to be massive. And here's why that supply-side hit is so critical. Immigrant labor is, without a doubt, the backbone of the U.S. construction industry. We're talking about a group that makes up nearly 30% of all construction jobs. So when you restrict this vital labor pool, you're not just creating a skills gap. You are directly causing severe worker shortages, which then drives up construction costs and pushes project timelines way out. Now, let's head just north of the border to Canada, which gives us a really different North American story. Canada was also facing a massive housing crisis, but they took a different path. The government slammed the brakes on immigration, and what that's done is create this fascinating real-time experiment on what happens when you directly curb the demand side of the housing market. Just look at these numbers. The effect was immediate, and it was dramatic. Canada's annual population growth just plummeted from a historic high of 3.2%, a rate they hadn't seen since the 1950s, down to just 0.9%. You're looking at a demand shockwave in chart form. So what does that shockwave look like on the ground? Well, take a key market like Vancouver. Home sales dropped to their lowest levels since 2019. At the same time, the number of active listings just shot up, 45% higher than the 10-year average. Suddenly, that core demographic of new renters, immigrants, and international students was gone. And almost overnight, the market flipped from a seller's dream to a buyer's market. So to sum up North America, you've got 2 sides of the same coin. The U.S. policy creates a supply-side problem, which drives up construction costs for the long term. Canada's policy, on the other hand, directly hits demand, immediately cooling off the rental and condo markets. 2 different approaches, 2 very different outcomes for investors to watch. Okay, now let's hop across the Atlantic to Europe, where the story is completely different. Here, it's not deliberate policy that's reshaping housing markets. It's an external event-driven crisis, the massive influx of refugees from Ukraine. This created a sudden, powerful demand shock that gives us a unique chance to actually quantify the direct impact of migration on housing prices. In countries on the front line, like Poland, the impact was immediate and it was stark.
For every 1% increase in a city's population from the refugee influx, rents jumped by nearly 0.75%. I mean, you can't get a clearer, more quantifiable link between sudden migration and rent prices.
And it's not just Poland. We see the exact same pattern playing out in Germany. A 1% increase in population from international migration led to a 1% jump in apartment rents. The key thing to understand here is that this new demand is laser-focused on the affordable housing sector, which puts incredible pressure on the exact same housing stock that local low-income residents rely on.
Now let's shift our focus to Asia for our final case study. Here, the big migration driver isn't policy or crisis, it's wealth. We're seeing a major movement of high net worth individuals who are de-risking not just their financial assets, but their entire lifestyles. And in doing so, they are creating brand new safe haven markets for luxury real estate. And the top destinations for all this wealth? Cities like Singapore and Tokyo. And the reason is really quite simple. They offer this perfect mix of stability. They're geopolitically neutral, they have a strong rule of law, and they have world-class infrastructure and healthcare. For Asia's wealthy, these cities are basically the ultimate safe deposit boxes for their capital and their families. And this table really shows you the money on the move. While China is seeing a major outflow of millionaires, Singapore and Japan are picking up that capital. We're talking projected net inflows of 1,600 and 600 millionaires, respectively. In Singapore, this is fueling a boom in family offices and propping up the high-end condo market. Meanwhile, in Tokyo, this new wave of demand is targeting the ultra-luxury residential sector, just adding more fuel to an already hot market. So, after looking at all these powerful new forces, the big question is, how should an investor actually respond? And that brings us to our final section, building a new playbook for navigating this really complex and fragmented world. If there's one big theme for this new era, it's the shift from fast money to slow money. In a world with high costs and high risk, you just can't count on simple market appreciation to deliver your returns anymore. Success is no longer about just buying and holding an asset. It's about generating stable, long-term cash flow through being an excellent operator. So this new playbook is built on 4 pillars. First, you've got to focus your capital in those mature democracies we talked about. Second, target beds and sheds, that's residential and logistics, sectors that are driven by fundamental demographic needs. Third, you absolutely must be pricing climate risk into every single investment decision. And finally, and this is crucial, you have to master migration analysis. Population flows aren't just a footnote in a report anymore, they are a core metric for your due diligence. Ultimately, all of this leads to a pretty clear and powerful conclusion. The winners in this new era of real estate won't be the people who simply own assets. No, success is going to belong to the strategists, the ones who can actually decipher the complex dance between migration, policy, and geopolitics. That is how you win in this new world of real estate.